Greetings, this is John Paulamy of the Actionable Intelligence Alert. Today is July 20th, 2016, and today I want to take some time to talk about what's going on in the gold market. As many people should recognize, the gold price has really rallied hard since the beginning of the year. In fact, we can see from this chart that I have up here that it appears that a bottom was put in around December 2015 to January 2016. This bottom was the culmination of a four-year bear market that took the gold price from its high in 2011 of $1,900 down to this low of around $1,050. Since then, the gold price has rallied about $250 an ounce to its recent high of around $1,370. Now, the chattering classes and the pundits on CNBC and Bloomberg and everywhere else, because of the nature of the 24-hour news cycle and the fact that they have to fill up the airwaves every minute of the day, are always standing around trying to figure out what's caused the gold price to go up. So we've heard everything from the risk trade is back on to Brexit and a whole bunch of other things that don't make any sense. However, I would suggest to you that we are seeing the end of the four-year cyclical bear market that started in 2011. And the reason that we're seeing the end of the bear market in gold is because of the main driver of the gold price, which is, in my view, interest rates, and negative interest rates in particular. Now, here's a recent Bloomberg article talking about, well, the headline says, global negative yielding bond pile nears $10 trillion. And they have a chart here that's kind of a neat little visual that shows the different countries and the amount of debt that each country has that's trading with negative yields. And what do we mean by when we're talking about a negative yield? What we're saying is that you buy for example, a Japanese or certain French bonds, and you don't receive interest. You have to pay the government interest to hold the bond. So in effect, if you buy a $1,000 bond and it has a 1% negative interest rate, you're only going to get back $999 at the end of that year if it was a one-year security. So that's just that's bizarre. I mean, who in their right mind would loan money to a country like Japan, which has a falling population, an old population, is extremely deep in debt to the point of being 200 to 300% of GDP, somewhere in there, and is a shrinking economy? Who is loaning money to these people and paying for the privilege? Well, they're not. For the most part, the Japanese central bank is just printing money out of thin air and is buying these bonds. So that's a bizarre circumstance in itself. In fact, there was a recent article that said that Japanese citizens, because of the fact that they can't get any yield from a passbook savings account, are just holding cash at home. Sales of safes to hold the cash in, I'm talking about metal safes, have increased by, I don't remember the exact amount, but it was shocking how much the increase in sales of safes were. So another article here by Frank Holmes at usfunds.com talks about the recent increase in gold prices, and it talks about negative real rates fueling the gold price. And I think this is an interesting visual here, because what you can see shows we have a chart here that shows the gold price on the left, interest rates on the right, which zeros here, these are positive rates, these are negative rates, and time from June 2009 to January 2016. And what you can see is back in October, or whatever it was, September, October of 2011, when the gold price peaked at $1,900 an ounce, real interest rates were at almost negative 4%. And you could see the trend here. You could see the interest rate trend from 2009 to 2011 was in a general direction of being down. Now, of course, there was a slight uptick here during 2010 in real interest rates. And real interest rates are the 10-year Treasury yield minus the inflation rate. So if you have, for example, a 2% Treasury yield and the inflation rate is 3%, you have a negative 1% real rate. Okay? So we had a trend where real rates were trending in a negative direction, and in fact became negative, extremely negative, and you could see the inverse correlation of the gold price going up. Now, this is amazing. Right almost at the peak, you see that there was a trend change in the real interest rates. Real interest rates were still negative, yet they were trending towards the positive. They were trending positively. And the gold price, of course, reacted to that. It began coming down. So since 2011, we've been in basically a cyclical bear market for gold. Gold, the price has come down from, like I said before, 1900 to about 1100. And now, if you look at the chart here on the far right, you can see that real interest rates are beginning to trend down. The change in direction, and they're slightly negative as we show right here, possibly around 0.5 to 0.75%. So, and you can see the gold price now is reacting. So, as I show in the chart here, Brexit was around here somewhere. I mean, this change in real rates, change in trend, happened back here. So I would suggest that negative rates are the real driver of the gold price, and that these trends, when the change in trend happens from negative to positive trending, once it comes into place, as you can see from the chart, once the trend changes, it stays in effect for several years. So I think that's what we're seeing here. We're going to see real rates head down, and we should expect the gold price to go up. And this is kind of confirmed even with, not just in the US, but all over the world. You can see all these different countries that are now have trillions of dollars of their debt trading negative. So I'm not going to get into the reason why that is on this particular video. That's a whole nother video in itself. But the thing I do want to point out earlier that the gold price basically went from about, in January of this year, from about 1050 up to a recent 1350 to 1370, which is about a $250 move, maybe a little bit less than 20%, maybe a little bit over 20%, 25%. But look at what some of these gold stocks did. Look at what Agnico Eagle did. It went from $22 a share to 55. Let's look at Caledonia Mining, one of my old favorites. The stock went from about 70 cents. You could have bought it in here for 70, 75 cents, and recently topped out at over almost $1.50, $1.60 a share. So those are well over 100% gains. So it's like a 3-to-1 ratio. And that's what we'd expect to see. If the gold price goes up 2%, we would expect to see gold stocks go up 6%. And that's what we saw here. We saw the gold price go up about almost 30%, and we've seen a lot of these stocks almost double. And these are just doubles. There's some stocks, some of your penny dreadfuls, some of your penny stocks that are up several 100%. So we're seeing a recent pullback here because we're way overbought. You can see how far advanced we are above this moving average. You can see the moving average is starting to turn now. We're gonna need to see this rally here retrace down into this area somewhere. I'd expect you'd see 1300, 1275, and then some sideways action before you might see another trend upwards. So my expectation is that we're in a gold bull market. It's resumed. The bear market for the last 4 years is over. The bull market has resumed, and it would behoove folks to keep an eye on prices. And if you do not have a position, I would suggest that if we get a pullback here into this area, that you establish a position in gold and a position in gold stocks. And I'll be coming out with some more ideas of what gold stocks to buy in subsequent articles. So that's it for today. Thanks for listening, and we'll talk to you soon.